I'm going to talk about the AM gap down strategy. We've also called this the dumb money gap down in the past, and you might see why in a few minutes. A gap down basically means that the stock opens lower than its previous close. I'm showing a real live example here. It closed where I'm marking that spot there, and it opens quite substantially lower. Now, it's called the gap because there's literally a gap between the previous close and today's open. But here's what almost always happens. When the stock plummets like that, it rises for a good 20-30 minutes following that open. In this real case, that stock gained 11.9%. How would you like to have that trade? Okay, now here's why this works. When there's bad news that comes out overnight or prior to the market open, this creates a panic or urgency for people to sell. So a flurry of sell orders come flying in prior to the market open, and the sell orders stack up. This causes the stock to plummet right at the opening bell. But see, eventually those sell orders get exhausted. Other traders perceive this as a bargain, and so a flurry of buy orders come in, and they stack up, and it jams the stock higher. It's really that simple. Okay, how do you locate these trades? Well, you go to OracleTrader and you click the Gaps and Traps tab, as I show right there. And when you do this is about 20 minutes or so prior to the market open. You want to look at pre-market data, and in this case that is contained in the AH gap column. If you click that column heading, it sorts. In this case we're showing the gap ups. Well, we don't want those in this case, so we click the heading again and it sorts the other way, which shows us the gap downs. Those are the stocks that are ready to fall at the market open. Then you can walk through them and make your selections. Okay, now when making a selection, when making a choice, follow these key rules. Rule number 1, don't play the gap down if the market itself is gapping up. In other words, if most stocks are ready to rise higher at the open, you don't want to play the lone stock that is falling, because that means that stock is falling for a very good reason, and I would avoid playing it. Okay, that's rule number 1. Rule number 2 is remember that this is a fast trade. It's a day trade. You don't want to hold for very long. Remember this example we just showed? Right here. Let me show you what happened right after that. You see? The stock got hammered once again. So you don't want to hold for very long. Alright, now rule number 3 is this trade is counterintuitive. This is very difficult for new people to get, but when there's bad news, there's doom, despair, etc. that permeates the market. And there's a tendency for everyone to want to get out. You have early panic selling, but it's an overreaction. Now, bad news does not matter to you. It does not matter. You need to go contrary to crowd fears. Alright, how do you narrow the field? How do you make a choice when there's a lot of stocks gapping down? Well, here's some good rules. First, favor the stocks that have bounced before. Take a look at this one. This is VRSN. It's going to gap down where I'm showing that red arrow. But now take a look. Look there when it gapped down. It sharply rose. Right there it gapped down and it spiked up. And of course right there it gapped down, and look how that thing soared. So this is a very strong selection. Alright? Now number 2 is favor stocks that show recent strength. There's a stock that does not show recent strength. It's going to gap down right there where I have that circle. But look at its recent activity. It's very dull and it doesn't show any strength at all. Well, look what happens after the market opens. The stock does not bounce because it doesn't really have any backing. Now, here's the exact opposite. Here's a stock that shows recent strength. It's going to gap down where I have that circle. Now, right there it shows some strong uptrend. There it shows a lot of strength. And there it shows a lot of strength. That's recent strength. That's the kind of gap down that will work best. Sure enough, look how that stock spiked at the open and then rose even further. Alright, now the third thing is to favor the sympathy play. Well, what do I mean by sympathy play? Well, for example, let's say in the financial sector, Bank of America has bad news, ticker BAC. Subsequently, it gets hammered. Now, what usually happens is all the other financial stocks also get pounded, but see, they're not the same company, so that is rather bogus. So you want to go with the cousins of Bank of America, not Bank of America. That's a very important rule. Play this method and you'll be surprised how much you can gain.